Welcome to Make Your Money Matter with Brad Barrett, the show that aims to change the way you think about wealth management. Brad is a financial advisor, established radio host, and author of Retire Right. He is a managing director and partner at One Capital Management, an SEC-registered investment advisory firm managing over $4 billion for clients across the nation. Brad and his team are dedicated to helping clients protect and preserve their assets so they can reach their investment and retirement goals. And now, your host of Make Your Money Matter, Brad Barrett.
Well, welcome in to Make Your Money Matter. I'm your host, Brad Barrett. I'm also a managing director and partner here at One Capital Management. And as we do every year over the past couple of years, our first show of the new year here in 2024, we want to take a look at what happened last year in the markets, in particular in the capital markets, as well as I think it's a great time to reset when we start thinking about the new year, new you, and what we should be looking at for 2024, some themes, if you will. And we're going to glean on a lot what happened last year and talk about what the quote unquote experts have said. But before we get started, make sure to go to our website at onecapital.com. You can click on our media tab there and you can download and subscribe to the Make Your Money Matter show. And I always ask, leave us a message and give us a review. It helps us share the show and share the message each and every week. And with that, let's get started. In thinking about the setup for the first episode of the new year 2024, going on our fourth season here, I want to talk about actually a story that I read a little while ago that actually was, I think it was perfect to set up what I want to share today. And it was actually from golf magazines. Now, I'm not the biggest golfer in the world, and I'm not expecting you guys to be, but this might resonate for those that are. But golf magazine's top teachers in 1997 were quoted, I'm going to mention a couple of them here, David Ledbetter, Dick Harmon, and Johnny Myers, were quoted about talking about Tiger Woods. Now, remember, this is 1997, right? Now, 2 months after these quotes came out, Tiger won the Masters tournament by 12 shots. This is what they had to say. David Ledbetter went on to say, Tiger is a tremendously talented athlete, but unfortunately, athleticism doesn't make one a winner. Right now, Tiger is a one-dimensional player who swings full on practically every shot. Dick Harmon went on to say, Tiger will win one tour event and do well to finish in the top 30. He's not ready to handle the pressure of a major. Again, 2 months after this was written, in 1997, Tiger Woods won the Masters tournament in Augusta by not just winning it, he won it by 12 shots. Here's the theme for this week's show. Tune out the naysayers. They're clueless. In the investment management world, there's a saying about analysts in particular, right? One analyst will say it's raining, one analyst will say it's not, and I always tell the investors to look out the window. The reality is we have to live sometimes to realize what's happening. By the way, this is not just true of your money, this is true of life. When I say they're clueless, experts last year, the beginning of 2023, so a year ago today, or this week, let's just say, this is what some of the quote-unquote experts were saying. Barclays assumed the S&P 500 was going to be down 4%. Morgan Stanley said, it might do 1%. Citigroup, 1%. Bank of America said it'd be up 4%. Goldman Sachs said 4%. Wells Fargo coming in with the biggest one at 12%. This is just a reminder that even the experts or analysts or whoever you think you're following are clueless. Friends, I've shared this often. If you ever find an advisor or someone in the investment world who says exactly what's going to happen or predict it, this, that, and the other, please run. Look, it's not facts to understand that you're hypothecating of what may or may not happen. No one knows what's going to happen tomorrow other than the holy above. And me saying that's just a reminder that no one knows the future. It doesn't matter how credible they may seem, right? It doesn't matter if they're talking about whether it's the stock market, homes, cryptocurrency, or anything else. It's impossible to know what will happen tomorrow. We know this at our core. Yet in the money world, I feel like sometimes we get dragged along by certain things that just sounds really good and shiny. And I see this all the time because it doesn't stop people out there, experts, quote unquote, from making predictions, which is why you'll hear from me. If you're a client here listening, any one of our advisors here, we don't make predictions. We're not in the prediction game. We're about proper planning, diversification, and managing all the risks that come across our portfolios or our clients' desks across and throughout the year. If you look back into a year ago and looked at all the predictions I just mentioned, just to see how wrong everyone was, you can see that they were way, way off. The S&P 500 went up double digits into the mid-20s for all of 2023. Managed portfolios were in the teens, high teens. And yet most of these experts were sitting here at -4 and 1% and 4%. These are experts, right? By the way, it's not a knock on any of these experts. I'm not saying these institutions I just mentioned aren't valid by any means, but it's the reality, okay? And I think if I'm speaking to someone today or this week, it's important to know that no one knows the future. And yes, that includes you, my friends. So if you're out there thinking, okay, Brad, what are you going at here, right? Because you probably heard this from me before if you listen to our show. And I always like the first couple weeks of the new year to talk about this because I think our minds are clear. We're outside of the holidays, the busyness of all of last year, all the rhetoric that was going on. We have a really, again, Monday morning quarterback or hindsight's always 2020, but we can look back and say, okay, what did we learn from last year? Well, we learned, as I just shared, that like this year, by the way, same predictions are going to come out for different things, right? The reality is we want to stay the course. You hear me say this all the time, okay? That it's not about timing the market. It's about time in the market. Get started. Right now, if you're thinking, okay, I want to do something different. This year, my goal is to create a side hustle or buy a new property or rental or something like that. All that's great. I'm not saying it's not. But sometimes I always say, before you go buy another house, make sure your current house is in order. Before going investing in some other investment, make sure your current investments are maxed out. Case in point, you got a retirement plan. Maybe you're contributing. That is good. That's great. Are you maxing out? Ask that first. Because before you start deploying assets elsewhere, max out what you can first. Fill up the buckets. Pay down the debt. Those are the kind of things that matter. Get rid of the headwind, if you will, to clear some space for you to actually succeed, for you to feel like you can succeed. Now, I shared this stat a couple times last year, but I think it's important and I updated it. Because if you look over the past 40 years, and I always use that reference point for two reasons. One, it's not 100 years, so it's not like some big body of work. You're like, well, Brad, it was much different in the 1930s. And I agree with you. But in the past 40 years, not only is it not that long, in compared to like 100 years in my example, but secondarily, many of us listening here have lived through the past 40 years. And I share this because one other reason I would add is that the last time in the US we saw inflation, which has been a big topic over the past 24 months or so, last time we've seen these numbers was about 40 years ago. And since then, okay, we've seen 6 recessions, and yes, we might be going on a 7th. We'll find out here this year when the National Bureau of Economic Research, studies that, and we'll go through that. We've seen 6 bear markets. We've seen 45 or so, maybe a little bit more, federal rate hikes. We've seen 2 50% stock market crashes. We've seen 12 plus U.S. involved wars. We've seen a global pandemic, literally a global pandemic, okay? We've seen a great financial crisis, which was a part of the 2 50% stock crashes. By the way, that's an anomaly in any time period. And that happened in the last 20 years. And since the last 40 years, all that time period, we're still double-digit positive on the S&P 500, around 10%. So think about that for a second, because I don't know where I'm speaking to you at right now. I don't care if you're in your 20s or your 40s or maybe even your 50s and 60s. That time period still applies to you. Now you might be thinking, well, Brad, wait a minute. I'm about to retire. I'm almost 60 years old. How does a 40-year time horizon apply to me? Well, pretty simply stated, that the same amount of time you had working, you want in retirement. I have been a financial advisor for nearly 2 decades now, and I have yet to have a financial plan or a retirement plan run where the person says, I want to run a plan and I know I'm going to die in 12 months. So only run it for 12 months. Hasn't happened. Now, not to say it wouldn't, but I just said it hasn't happened. We don't plan to retire and just live for a year or two. We plan for what we can't control, and things maybe get out of control in our life. We know that because there is uncertainties in this life, as I share often, but we have to plan for what we want and desire. And we want and desire to have 30 or 40 years in retirement. So yes, it applies to you if you're close to retirement. And yes, it applies to you if you're 20 and 30 listening to this, because now's the time to act while you're making income, while you're in your earning years, to put it away and to help it grow. Because if you get sidestepped by all the nuances that happen in this world, all the naysayers, all the quote unquote experts, as I mentioned, predicting this, that, and the other, you're going to lose sight of the goal. I mean, did you know the average bear market, by the way, the bear market, a rough, rule of thumb for that is when the market dips down below 20%, the average bear market lasts about 1.3 years, while the average bull market lasts around 6.6 years. Think about that.
Stay connected. Get frequent updates on the show. Follow Brad Barrett and Make Your Money Matter on most social media platforms. And catch full episodes of Make Your Money Matter streaming now on our YouTube channel. To schedule your no-obligation appointment, go to onecapital.com or call 805-410-5454.
And I get it. Look, to be fair, if 2022, which is our last bear market we just had a year ago, if that was your first bear market, I get it. It can be a gut punch. Don't get me wrong. It's not fun. But as you experience more market cycles, and I can only share this from my experience as an advisor and an investor, okay? I've been in this financial markets, the capital markets for 2 decades now. I've seen a couple. I've seen a 2008 financial crisis. I've seen government shutdowns. We've seen impeached presidents. We've seen global pandemics, 3 bear markets in that time period. But as you experience, like I have, and many who you talk to, more market cycles, I will say this, and I know it's going to sound a little cliche, but it gets easier to ride the wave, if you will, of the market and build wealth. Again, back to my notion of staying in the market versus timing the market. Okay, time in the market matters most. And you think about this in the context of math for a second, not to bore you, but most of us have a mortgage. All right. If you think about a mortgage, a 30-year fixed mortgage, which a lot of us have, and if you were to open that up, nerds like me have to, and you break down each year on what's called the amortization schedule. Now, many of you might know this, but food for thought and food for fact here. The first 10 or 11 years of your 30-year mortgage is mostly interest. They invert the interest payments first, and then you start paying down principal. Friends, that's the same math you use for your other side of your balance sheet, the wealth building side, when it comes to compound interest. I just sat with a client the other day, and he's been on the job and worked in a career for about 16 years. Okay, and he plans on working another 15 more total. And the first 15 or 16 years, between his contributions through also starting a family, buying a home, he amassed about $300,000 in a retirement plan at that point. And I showed him a very simple calculation of time value of money for the next 15 years. And it showed the math. And by the way, I did 15 years and I did a assumed rate of return, I think conservatively, but it's assumed, not guaranteed by any means, of 5%. And I did his same contributions, and it was right around $1 million. And he was blown away because he's like, wait a minute, it took me 15 years to get to 300. How in 15 more years am I going to get to $1 million? Compound interest. Think about a snowball. You roll it up the hill, you're gaining and gaining more snow. So it gets easier and bigger and bigger. Friends, time in the market is really what matters here. So as we start this year off, we look at predictions. We even the story I mentioned about Tiger Woods and all these people writing him off, and then he goes and shows him 2 months later and wins the Masters, by a landslide. It matters what you think. Did you know on average we have about 40 to 50,000 thoughts a day? Ask yourself this, how many of those thoughts are negative? And by the way, this bleeds into a lot of aspects of our lives, not just money. But then how many of those aspects, how many of those thoughts come back into your money context? And I say context a lot because I think how we perceive and look at wealth building is different than I think how you are marketed to, the media in particular, especially social media. And so I think more than anything, as always on the first, episode of the new year, I always share, if you haven't found that counsel, if you haven't found that advisor to talk with, do so. That's your first step. Yes, get your stuff in order in terms of like your debt and all those things are big, but have someone help you with that. Find counsel, find that advisor, build trust in someone who's credentialed, fiduciary, experienced. Find that person because that ultimately is going to be the person you want in the foxhole with you when things get tough again. And I don't know. Look, I'm going to be flat out with you. No one knows. Obviously, you can see from the stats I brought up to you from last year, no one knows what this year's market holds. But what you can do is you can plan for the uncertain. And you want to make sure you're doing so. So ask yourself another question is, are you ready? Do you feel like your plan and your portfolio is diversified well enough to weather whatever happens this year in 2024? If the answer is not sure or no, that's the impetus for a call. That's where you reach out. Find someone you can trust. It doesn't have to be us, okay? This podcast isn't about that. It's really more about education and awareness within the financial services community. But we are here to help if you would like us to. You can reach out to us on our website or our phone number, all of which is attached here on the podcast. But make sure you find someone to do that with because that, I think, as you start the new year, is the first step into really creating a holistic wealth management that'll gain and grow wealth for you over time. Hey, hope you enjoyed that today. Thank you for listening to the Make Your Money Matter show. As always, before acting on anything discussed today, make sure to reach out and speak with a financial advisor near you about your specific situation. Or again, if you'd like our help, you can reach us at 805-410-5454. And until next week, always remember to make your money matter.
The information in this show is educational and general in nature and does not take into consideration a listener's personal circumstances. Therefore, it is not intended to be a substitute for specific individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.